Um, so like I said, we're joined here with Mark Nelson. Here's a little bit of bio on Mark. He's active in the American Accounting Association, and he served 3 terms as the area editor of Accounting Review. And he currently serves as the chair of the 2015 AAA Doctoral Consortium Committee. Mark served a 4-year term on FASB's Financial Accounting Standards Council, and he frequently leads discussion groups at the FASB Financial Accounting Conference. Mark's teaching focuses on intermediate accounting for undergrads and MBAs, and he's won 8 teaching awards at The Ohio State University and Cornell. And with that, I'll let you take over, Mark.
Thanks, Dave. Thanks very much, and thanks for the kind introduction. Why don't we just go ahead and jump in and think about this new revenue recognition standard and how we should attack that in intermediate accounting. So what we've done is to prepare an entirely new chapter of our book, and we've worked really hard on it. So it's a great opportunity for me to get to share it with you today. Let me walk through a few kind of overview aspects of this standard that has just come down the pike in late May. So we all know that ASU 2014-09 revenue from contracts with customers is now out. The standard is very comprehensive. It's designed to supersede hundreds of existing pronouncements somewhere in U.S. GAAP, and it's also virtually converged with IFRS 15. There are some tiny differences, but it's fair to think of these as 2 names for the same standard. In the U.S., this standard is effective for public companies for annual and interim periods starting after December 15th, 2016. So think of it as coming online in 2017. And there isn't early adoption allowed under U.S. GAAP. IFRS, it's also required in 2017, but earlier adoption is permitted under IFRS. And the interesting thing about that, one of the things we sometimes talk about is when things are covered in the CPA exam, focusing only on the fact that this isn't required until 2017 and there's early adoption allowed, we would expect this to be tested in the CPA exam starting in, say, mid-2017. But remember that IFRS is also covered in the FAR section in the CPA exam, and because of that, and because IFRS allows early adoption, this could be covered as soon as January 1, 2016, under the guise of IFRS. So it kind of backdoors this standard into the CPA exam as early as the start of 2016. That date might slide, but right now that's what the AICPA has said. So that's kind of interesting. It really means that for juniors today, we certainly need to be thinking about them understanding revenue recognition in this great new world. One other thing is that in adopting this standard, there's a couple of alternatives for adoption. There can be a sort of a traditional retroactive restatement, or there can also be a version of the cumulative catch-up. They call it a cumulative restatement, where it just cumulatively restates up to retained earnings at the start of the year of adoption. So it doesn't roll through income, but it also doesn't restate prior periods. And so we'll have a little bit of lack of comparability here when this thing comes online. Okay, so when we were looking at this standard, and we spent a lot of time kind of thinking about how we would attack this, both in our own courses and therefore in our text. And what we ended up doing is creating a kind of a tiered process. And I wanted to talk about that a little bit because it's going to affect how I do this today. I think of this talk as hopefully giving people some insight about how to teach under this standard, as well as some understanding of some key aspects of the standard. So what we did was we start our chapter with a part A that's this straightforward introduction to the 5-step process that's used to implement the new standard. And the idea there is for students pretty quickly to be recognizing revenue, both for a contract where that's appropriate at a point in time, a contract where that's appropriate over a period of time, and then for a more complex contract that includes multiple performance obligations. One of the interesting things about the standard is that it can take a while in the standard to actually be recognizing revenue, and what we wanted people to do is to have this baseline understanding for lots of common transactions to be able to hit that, and this is designed to give instructors some flexibility. You can stop here if you want. If you want to go more in depth, we've got a Part B. And Part B includes deeper coverage of a lot of key topics. So it includes estimating variable consideration, which is a big deal under this standard. It includes estimating standalone selling prices, and includes lots of different common contractual arrangements: prepayments, warranties, franchises, right of return, bill and hold, consignment, seller payments to customers. Just a bunch of things that we have to figure out how we handle under this standard. And today's talk is going to walk through Part A to sort of lay this foundation, and then it's going to go in depth into the topic of estimating variable consideration, which I personally think is a really interesting part of this standard. It's, I think, in some senses, the biggest new thing, and it's got some complexity to it. I thought that would give us the best bang for our buck as we were attacking this topic in the short time we have. Just another couple points to make. We also include a Part C, which deals with accounting for long-term contracts under the standard. We still have an approach for recognizing revenue over time that's like the percentage of completion method, but we don't use that terminology anymore. And when you qualify for it is different under the new standard. And we also, of course, have something like the completed contract method, but again, when you qualify for it is different under the new standard. And then our chapter includes some financial statement analysis stuff, profitability analysis, DuPont analysis. And then we include an appendix that covers superseded GAAP. Because one of the interesting things about this new standard is that this protracted phase-in period for the new standard means that there's going to be a time when students are potentially wanting to know both the GAAP that's going to be superseded as well as the new GAAP. So this appendix includes a lot of coverage of things like the realization principle, the installment method, accounting for software contracts and worrying about VSOE and that sort of thing. Things that are going away or changing dramatically under the new standard, but we want to have coverage. So anyway, the idea here is to lay the foundation with Part A, and then to drill down into particular topics, or lots of topics, depending how comprehensive someone wants to be. Today we'll drill down on the variable consideration aspect.